Good morning, everybody, and thank you for coming along today, and certainly thank you for your interest in Treatt. You have all seen the numbers this morning, which we're very pleased to share with you today. Despite COVID, supply chain issues, and the site move, we've delivered, we feel, a very strong set of numbers for this financial year, and the team have done a fantastic job, and I give our team due credit for all the work that they've put in to deliver these numbers. So a record performance across all of our key metrics in the business, solid revenue growth of 14%, a real improvement in the gross margin in the year, and we'll come on to talk about some of the reasons of why that is, but a very strong margin performance. Profit up to 20.9 million, so 41.3% increase on last year, and you can see the other important financial metrics there, including the dividend increase of 25%. But the team have certainly performed very well. But last year was last year, and in this presentation, I'd like to talk about some of the reasons why we're excited about the future. Next slide, please. So I cannot overstate what a remarkable year it has been for the business. Certainly a very strong performance has been driven by growth in addressable markets, and I can give you an example of that. Some of our wins that we've had in canned alcoholic cocktails, for example, where consumers are choosing a canned cocktail as opposed to an unflavoured beer. So that's an example of where the addressable market has been growing for Treatt. Profit before tax materially exceeding our initial expectations is a remarkable performance in what has been, of course, and what remain challenging times in the world. Happily, there's been no material impacts from global supply chain disruptions, and our team have done a remarkable job in sort of navigating through some of those challenges. But we're experienced in handling some of these supply chain disruptions around the world through climatic events over the world. 80% of our portfolio is natural, and therefore we've got the skill and the experience to mitigate some of those supply chain disruptions. Our margin growth has been very pleasing, led by our healthier living categories of tea, health and wellness, and fruit and vegetable extracts, where we're bringing great authenticity into our customers' beverages. And we've done a good job. The team have done a really fantastic job of navigating through the many challenges that COVID has brought the business, operational challenges, and also the skill that our teams have successfully navigated the channel shift from the on-trade to retail, and then progressively back to an on-trade to a more balanced consumer pattern. But there's certainly been some turmoil in the channel shift. But the team have done a great job in navigating through those challenges. We continue to invest to build our platform for future growth, and we'll come on to talk more about that in terms of our UK headquarter relocation, which is progressing very well. And importantly, we're working very hard at embedding sustainability across our business. So sustainability becomes the lens through which we make all of our decisions as a business. Next slide, please. So on slide 5, I want to take a deeper look and talk about really where the growth has come from in the year, and also the direction that we're heading for the future. I mentioned ready-to-drink cocktails, which includes alcoholic hard seltzers, and we've certainly won some important market share in the year through the provision of our natural and very authentic extracts. Our coffee platform is beginning to see some success, and I'm sure we'll be talking more about that as we go forward. But these are examples where the market that we serve and our strategic relevance to both channels for market is coming through very strongly. And as we've transitioned the business from the trading company that we were 10 years ago, with some manufacturing and some science, to become very much that science-led manufacturing business that we are today, the provider of authentic natural extracts, we've progressively positioned the business to be very relevant for both of our channels to market. So as I mentioned, we've seen some very strong growth in our healthier living categories, which continue to perform exceptionally well in the market as consumers increasingly look for authentic, better for you products. And the beverage market itself continues to trend towards premiumization. Some great innovation in the space and some good opportunities that we've realized in the period around sugar reduction, which has been part of our portfolio for some time, but we continue to see some exciting growth there with some of our very high-tech extraction technology techniques, bringing some fantastic authenticity to that part of the world in beverage. And we've also, in the period, launched a new range of tea extracts to supplement our rapidly growing tea portfolio, which has been an important part of our growth in the period. We've also seen some improving margins in our core citrus category, and this is really a result of the great work we're going on from our scientific teams, improving the authenticity, the sophistication of our citrus category, improving our mix of value-added products. And in terms of investment for the future, new UK facility is seeing people now moving across from our old facility, so the offices increasingly populated, but we look forward to the future as we've now begun commissioning our plant and machinery, and we look forward to that continuing over the next year. We're also investing at this point in our growth in our people structure for the future. We're bringing in some senior people into the business. Jonathan Whitworth has joined us as our Chief People Officer. And Jonathan came from Babcock, bringing that bigger company experience into the business. And Wolfgang Tosch will be joining us in a couple of weeks' time as our Chief Innovation Officer. Wolfgang is a qualified master brewer and also has a lot of experience in some other platforms such as tea and coffee. The next slide, please. So I want to sort of take a deeper dive into the work that we're doing around ESG. Now, we've said for many years at Treatt that ESG has always been really in our DNA as a business. But what we've done in the last year with great support from our sustainability consultant, CIFA, is to really further embed sustainability into our business, so it does truly become the lens through which we make all our decisions as a business. There's an awful lot of training going on across the business to really embed that thinking into the business. And for example, there's lots of already good work that we're doing around calorie reduction in beverage, which is an important part of the S in ESG. But we're doing an awful lot of work around supply chains to identify both the risks and the opportunity through that sustainability lens, working with our supply chain partners, deepening the already fantastic relationships we've got with our supply chain partners, and getting more out of those relationships, but in a very sustainable way for the future. We're also doing a lot of work on obtaining our data in the business so we can begin to think about the right sort of climate targets, the carbon targets that we're going to be having in the future. So lots of good work going on in the area of ESG, and with our portfolio being 80% natural, we're already in a very good place indeed. Next slide, please.
Right, good morning everybody, and if I could just add my thanks to you all for joining us today. So if I turn to slide 8, this slide really reflects the sustainable growth in profits that we set out to achieve when we remodeled the business back in 2012, and it has culminated in this very strong performance over the last year with 41% growth in profits. And this remodeling of the business has been very much about moving Treatt from having been a trading business with some manufacturing and some science to putting manufacturing and science at the front end of the business. One of the things I would like to draw out in this slide is the unusual H1, H2 profit split that we experienced over the last year, which unusually was 50-50. And this was a reflection of the channel shift that took place from on-trade to off-trade caused by the pandemic. And we certainly see in the next financial year returning to a more normal 40-60 seasonality which has traditionally been driven by the beverage consumption in the Northern Hemisphere. So if I can now turn to slide 9, which shows our dividend progression over the last decade. We've always had a progressive dividend policy, and I'm very pleased to report that we have increased the dividend for the total dividend for the last year by 25%. And this is very much part of our capital allocation strategy as we continue to invest in organic growth for the business. So moving on to slide 10 and looking at the income statement in more detail. Looking at the revenue growth, which in reported terms increased by 14%, it actually increased by 18%, a very strong 18% in constant currency. And when you combine this with the 480 basis point increase in gross margin percentage, this resulted in gross profits increasing by over 32% for the year. As you'll see, there has been a material increase in administrative expenses, which very much speaks to the fact that we are investing in skills at all levels across the business. The exceptional items, as last year, only relate to the one-off UK relocation expenses, such as dual running costs, as we anticipated and guided towards. So moving now on to the cash flow on slide 11. As you can see, we've had a strong underlying cash performance with operating cash inflow of £24 million. We did see working capital increase by 10 million in the year, and this was as a result of inventories, as our procurement teams took prudent steps to manage our inventory in light of the global supply chain issues, which we all know about. We spent £9.5 million on CapEx for the new UK site. And over the next 2 years, we have about a further 7 million to spend, and we will receive back 5.6 million in February next year as a result of the sale of our old site. Our normal CapEx running rate is about 5 million a year. So now looking at slide 12, which analyses the individual products. So the standout performing area of the business was our healthier living categories, which grew by a very strong 64%. Now within this, the standout performer was tea, which was up 113%. This was the result of material new product wins, but also the return of the on-trade, which had been lost in the previous year. And the kind of products that our authentic tea extracts go into are things like iced teas for the principally for the North American market, and also hard teas as well. Fruit and vegetables, which is also part of our healthier living categories, has grown double-digit for a number of years now, but this year saw a very strong 60% growth. And this is where we buy in fruits and vegetables, and we extract the authentic aroma and flavor from those materials. So for example, we buy in cucumbers, we extract the cucumber essence, which can be used in a cucumber flavored tonic. The third leg of our healthier living categories is health and wellness. And this is principally around the space of sugar reduction. And again, we have another year of double-digit growth in this area as the trend towards removing calories from beverages, carbonated soft drinks, that kind of thing continues. And we also had very strong growth there with 29% increase in revenue from our health and wellness category. Our citrus category, which is our largest category, and Treatt has been in citrus for many decades, whilst flat in revenue terms, actually contributed 200 basis points of the 480 basis point increase in margins, which very much reflects the move towards more added value, more sophisticated products within that category, which, for example, has come out of our investment in water-soluble citrus technologies. Our second largest category is synthetic aroma, as not every market needs natural, and that's all 9% growth. And this includes things like alternative proteins. So now turning to slide 13 and looking at revenue by routes to market and by geographies. So as many of you will know, we have two principal routes to market. So there's the indirect route through the flavour and fragrance houses, and the direct route through to the brand owners themselves. But what I should emphasise is that our margins are driven by our product categories and not by our routes to market. So for example, selling a sugar reduction product to a flavour house or a brand owner will get a similar margin, and it will be a higher margin than, for example, selling a synthetic aroma to either of those two routes. So, and both routes grew strongly in the year, with the indirect route growing slightly stronger than the direct route. So turning to the right-hand side of that side and looking at our geographies, we saw strong growth across all our major territories. US was up 22%, UK revenue was up 28%, mainland Europe was up 18%, and China was up 8%. The rest of the world was down. This is across a wide range of territories and had differing COVID impacts at different times during the year. So now turning to slide 14, this shows the 5-year progression, just building on this theme of moving from a traded to an added value business. This shows that over that period, the proportion of our revenue that has come from added value has increased from 68% to 82%. And that has very much driven our improvements in gross margin. Our margin growth has also been driven by product mix, as the faster growing categories are also our higher margin categories. We're also now benefiting from the economies of scale from our US expansion, and we do expect further margin benefit over the next few years once our UK relocation is complete. So now turning to slide 15, and you can see that as a result of this, we are now within our medium-term targets for net operating margin, or EBIT margin, which is now 17%, with a target range of 15 to 20%. And return on average capital employed is now beginning to see the benefits from the US investment, as we are now within our target range at 21%. And we do expect further benefit to come through in return on average capital employed once the UK investment of our new site comes on stream. So I'll hand back to Damon now.
Okay. Thank you, Richard. So you've heard about a few consumer trends which have driven the numbers. And I just want to take a deeper dive in some of the reasons which are behind those numbers. So what does a consumer want today? First of all, a natural extract that tastes really good. Transparent supply chains are becoming increasingly important. An environmentally sensitive production method, clean label, low sugar, and authenticity. Putting all those factors together, that drives a premium drinking experience for the consumer. And Treatt are playing a very strong role in all of these important consumer trends. The evolution really in terms of functional, from energy drinks into a more natural functional drink, such as cold brew coffee, which does the same sort of caffeine impact, is seeing some important growth. And we're playing an important role within that space, within our coffee platform. But natural, transparency, clean label, authentic, and low sugar are very strong cards within the Treatt deck of experience and abilities. And we're bringing that to bear in terms of the numbers, not just for now, but also the important trends also for the future. Thank you. Next slide. So some examples of the sort of areas that we're bringing our technology to play, where we bring relevance for the market. If we think about cold brew coffee, there are some varying qualities of ready to drink cold brew coffee in the market. And the reason for that is that the qualities, to get a really good coffee extract is a real challenge. When one goes into a coffee shop, there's a really good reason why baristas are freshly grinding coffee beans. And that's because the flavor molecules in coffee begin to degrade as soon as one starts processing or meddling with the beans. We've built some technology in this space which enables us to preserve the fresh ground, fresh roasted character of coffee and impart that into a ready-to-drink cold brew coffee beverage. If we think about ready-to-drink alcohol, for example, a gin and tonic with a twist of lime in a can would be an example of that. We're having some good growth in this space, and it's not just about hard seltzers, but increasingly across a wider range of the ready-to-drink sort of cocktail space. That's a good example of the growing addressable market, which Treatt are speaking to. For every can of unflavored beer that's left on the shelf, and instead the consumer chooses a ready-to-drink cocktail, that's a growing addressable market opportunity for our business. And we've certainly captured some important market share in that space. And this is a trend which is expected to grow continually, quite strongly in the medium term. And functional drinks are becoming more and more important. What the consumer wants is something natural, authentic, with the impression that there's sugar present, but certainly less sugar. And our technology certainly works very well in that space. And that's fed into the numbers in this year and will continue to feed into the numbers in future years. So these important trends in beverage speaking very much of how we've strategically changed the business to provide great relevance to the beverage market. Next slide, please. So I want to talk a little bit about the benefits of the new UK site. The exciting thing is for us, we've got colleagues working now from the new UK site, but we've already started to bring customers in to work with our teams on the benches. That important co-collaboration model, that co-creation model, which we've created with customers, is beginning to move into full swing in the new facility. And I must say, the reaction from the sales team and also our customers around the new facility has been absolutely first class. It's exactly what we hoped it would be. What we've built is a world-class infrastructure, which really does reflect the sort of business that we've become at Treatt today. By putting science at the front end of the building, it's immediately apparent to customers on arrival that we've transitioned the business strategically in a very meaningful and positive way. So we're beginning to commission the plant and machinery that we're bringing into the new site, and that process will continue to about mid-2023. We always baked a year of dual running the old site and the new site into our numbers to make sure that the new production equipment, the new technology produces the same qualities as the equipment in our Northern Way site in Bury St Edmunds. That will bring a significant increase in capacity once we're fully commissioned in mid-23, and that's obviously a very exciting thing for the business. But it's more than just capacity. It's about productivity, efficiency, and we're really moving from a very analog manufacturing process to a fully digital one. And that's going to be really exciting in terms of the data, the productivity gains, and so on. And when we take a step back and think, we've got to the point in our business evolution that, we've got to here today from a rather suboptimal site in Northern Way. The future, when we think about Skyliner Way, our new headquarters, is really exciting for the business. We've increased the size and the scope and the quality of our innovation and R&D lab. So we've got a fantastic environment now where we can bring customers in, where they can co-create with our teams, where we open our toolbox to our customers so they can be very much part of their own solution, working with our experts. And that's really important in building client collaboration, which is absolutely critical for the long term. And one of the reasons why we've got such high quality, long-term customer relationships. Next slide, please. So turning then to the current trading and outlook, we expect the strong growth in revenue to continue. We're excited by that. We're also excited by the material opportunities that we see, the products, the projects we're working on with customers, the sort of new categories we're getting into, such as coffee, give us a lot of optimism for the future. Our momentum is building in China now, where we've got our own business now in China. Treatt China is now set up. And we see China being potentially somewhere in the mid-teens in terms of Treatt revenue in the medium term, somewhere around the 5-year mark. So lots of opportunities presenting themselves in China. We also look forward to manufacturing being underway at our new UK facility during the financial year. And we're having our first Capital Markets Day on Friday, the 21st of January. And we hope to see that as many of you as possible there. Look out for the invites, which will be coming shortly, but that will be a great opportunity for us to really showcase part of the treat business that we're really excited about for not just for now, but also into the future. As I mentioned earlier, we're busily strengthening the executive team to support growth. This feels like the right moment to do that in the treat evolution. We want to build that important platform to kick on this growth that we've built upon in this last 9 or 10 years. But now we see a material opportunity with our new site and our increased capacity in the US. And we really want to push the business on. We feel that now is the time. Richard mentioned a reversion to sort of the more historic first half, second half split, and I think that's absolutely right. The more seasonal pattern we expect to return to. But when I take a step back and look at the business, look at all the opportunities that we're working on with customers, the sort of quality of customers we're getting on board, the people that we've got in the business, fantastic colleagues across the Treatt Group, we remain very confident in the outlook, not just for the short term, but also importantly for the longer term for our business. Thank you very much.
If you'd like to ask a question over the phone, please press *1 on your telephone keypad. And we'll take our first question from Sarah Wellsford in Edison.
So, good morning, gentlemen. I had 2 questions, if possible. First of all, the inventory was up quite substantially, and you've explained why in terms of the 2021 position. But how do you see this developing in 2022? Do you feel that the inventory is going to continue to go up from here effectively as a percentage, or are you happy with the new level, or equally do you think it will revert back? And secondly, you've talked a lot about beverages and where you see the market developing. You also mentioned alternative proteins. Can you give us a bit more detail about how you see this market developing? Thank you.
You take the first, I'll take the second, Richard.
Okay, yes. In terms of inventories, I don't foresee as a proportion of our growth over the next year, the inventory levels going up disproportionately. They could well fall back if the global supply chain issues ease. But it is part of our business model to hold inventories in line with the order book. So it's also a reflection of the strength of the order book. But I don't see anything happening disproportionately from where we are now.
Thank you, Sarah. And in terms of alternative proteins, this is part of our partnership, a long-term partnership that we have with Robinson Brothers Endeavour, where we provide some high-impact sulfur nitrogen-based compounds into the flavour industry, who are, of course, busily making compounds to support the flavour of the rapidly growing alternative protein market. So whilst our primary focus is on beverage, we also play an important role in the provision of these high quality compounds for this growing area of food as well.
Okay, thank you.
Thank you. And we'll take our next question from Charles Hall in Peel Hunt.
Morning, Damon. Morning, Richard. Well done on a terrific set of results.
Thank you.
Couple of questions. Firstly, China. You've obviously sort of given a view as to where the opportunity could be to develop that business to mid-teens over the next few years. What are you seeing now to give you confidence in that? And what are you doing to be able to service that potential customer base, either in terms of personnel and getting product into China? I'll keep my second question for when you finish that first one.
Right, thank you, Charles. Well, first of all, we're building our team in China, and we're very encouraged by the quality of relationships we're building, primarily with large national beverage companies in China. And we're already working on a large number of projects, and we've got consumer trials going on in some cases as well. And I think what gives us encouragement there is the growing consuming middle class in China. Certainly the young consumers want innovation in beverage particularly, is certainly coming through into that space, and it's these kind of factors that give us a lot of hope and optimism for the progress that we want and feel we can make in China. We are working with a third-party manufacturer in China for some of our ingredients, to solubilize some of our ingredients, and it's part of the learning curve for us as we sort of embed ourselves further into this territory. But we're able to supply our highly concentrated extracts from both our UK and US facilities into China, but we think we can bring great relevance to this market, and certainly it's a market that we're paying close attention to, because the potential is tangible.
Great. And the second question is, obviously lots of supply chain issues around, and I think you're managing them extremely well, but are there areas where you're seeing pressures, either in terms of getting raw materials to your operations or getting finished products to customers? How are you managing all of that?
Well, first of all, our logistics supply chain teams have all done a fantastic job over what has been, of course, a very, very challenging period, and remains so. I mean, we're not immune from absolutely everything, but in terms of what's happening in the wider market. But our teams have successfully navigated through some of this turbulence, and a lot of that experience that we have in-house comes from dealing with a portfolio of natural products for many decades. We're used to supply chain difficulties around climatic conditions such as hurricanes in Florida, or freeze in some part of the world affecting citrus crops, for example. So we've got the experience in-house to help us navigate through some of this turbulence, and the teams are very experienced and have got great ability. They've made some early decisions, and part of our inventory holding, as Richard mentioned, is to provide that insurance policy in terms of when supply chains get difficult, we can successfully navigate our way through. So the team have done a great job. We're not being complacent in any way. I'm sure there's going to be challenges going on in the future, but we're working very hard at mitigating those.
And thus far, you've been able to get the product through to customers on time in full?
Correct.
Yeah.
Brilliant. Very good. Thanks very much.
Thanks, Charles.
And just handing back for webcast questions.
Thank you. So our first question from the webcast comes from Cathal Kenny. She has 3 questions. What's the outlook for gross margin in FY22, and what are the main drivers of GM percentage? Her second question is a route to market question. Growth with flavour houses grew by 18% in FY21. Can you provide some additional colour on this? And her final question is surrounding geography and category. As you scale and embed sustainability in your innovation agenda, is there any additional cost to meet this need?
Would you take the first one?
Yeah, sure. So Cathal, I'll just correct he. Thank you very much for your question, Cathal. So in terms of our margins and the sustainability of our margins, the faster growing categories, as I mentioned, are our higher margin categories. So our health and wellness, fruit and vegetable, tea, we continue to see those as being our fastest growing categories over the next few years to drive margins. And I don't think we can understate the benefit that we're going to get in margin terms from our UK relocation as well. There are a multitude of operational benefits, as well as the sophistication of the investment that we're making in high-tech plant and machinery. Of about the £45 million spend, almost £20 million of that is in automation and digital manufacturing processes. So we see further margin progression coming from that. Now, in terms of our natural products being 80% of total revenue, again, the fastest growing categories are all entirely natural. And therefore, it is likely that that is going to continue to grow as a proportion of our overall revenue. Damon.
Sorry, would you mind repeating the second part of the question again, the routes to market?
Absolutely. So the routes to market question, growth with flavour houses grew by 18% in FY22. Can you provide some additional colour on this?
Yeah, I think thanks, Cahal. I think that's a really good question. I think the way we've positioned the business strategically is that we provide great relevance to both channels to market. And we've got some fantastic relationships with our flavour house partners who themselves are doing a fantastic job in this space. But our job has been to provide relevance in terms of that authentic natural extracts and other products as well around alternative proteins, as we've already mentioned. And we're quite agnostic about routes to market at Treatt. We very much enjoy supporting our flavour house partners, and we also enjoy the direct relationships we have with the brand owners as well, principally in beverage. So I think we can expect, I would say, that channel, those in absolute terms, growth from both channels will continue. And the third question again, please.
Yes, the third question was on as a scale and embed sustainability into your innovation agenda, is there any additional cost to meet this need?
Richard, do you want to take that?
Yeah, in broad terms, as Damon said, sustainability is very much part of Treatt's story, has been for many decades. So, for example, our largest category of citrus, we are using a byproduct from the citrus industry that otherwise would be a waste product. So broadly speaking, our ESG agenda is more about a continual progression of the business, and there's no specific material investments we need to make to continue to drive at the targets. It's far more about making sure that investors understand what our targets are and how we can contribute to the sustainability agenda.
I think what we're doing internally is revisiting our processes, looking at efficiencies around energy or water usage, and those kind of initiatives have been underway for some time, and they're important pieces of work that we're doing under the ESG lens.
Our next question comes from Dan Thornton from Barclays. What customer wins most excite you? What is the pipeline for RTD coffee? Commercialization or new customers?
The flippant answer would be the customer wins and excitement are usually the largest ones, but that's not always the case. I'd say there's customers that we can grow with which show the most potential. And we've worked with a number of customers in areas that are trending in beverage, such as low and no alcohol, for example, which is going to see a lot of growth in the future. Some of these customers have come to us when their business has been at the very beginning, relatively small or literally at the first stage, and we've grown with them. So it's not always about the biggest names. It can often be where the most potential is and where we feel we can bring relevance to their growth in terms of the provision of natural extracts and other ingredients. And the second part again, please. RTD coffee. So RTD coffee, we feel, shows a lot of potential for us as a business. We've been busily developing that platform and that technology now for the last 2 or 3 years, and we're seeing some successes in this space, and we expect this to be a category which we'll report on probably in 12 months' time.
Thank you. We have another question from the conference call, so if I will hand it over to the operator to take that one.
Thank you. Our next audio question is from Nicola Mallard in Investec.
Right, my question's been on the webcast, so apologies for the duplicate, but I'll fire away. On the margins, I think, Richard, you've already sort of talked about this in terms of there's still scope for the gross margin to go up as that mix changes. Do you still feel 20% is the realistic top of your target range for EBIT margins? And then also going back to the sort of channel split, whether you go direct to the branders or whether you go via the flavour houses, do you actually sell different products to those customers? I'm just wondering whether for the branders, whether you sell a complete solution, whether, you know, perhaps to the flavour houses you're selling a single ingredient, which they're then putting in a solution for their customers. Thank you.
Great, thanks, Nicola. So in terms of EBIT margin, obviously we're at 17% now, so 20% doesn't seem that far away. So could it go above 20% at some point in the future? That is certainly possible with the efficiencies that we expect to come from our new UK site. And the fact that we can grow both our manufacturing facilities in the US and the UK in very modular ways, which will drive at economies of scale as well. With, on top of that, the fact that the faster growing categories are the higher margin categories, which I mentioned before. Damon, do you want to take Nicola's other?
Thanks, Nicola. The question of products, there is overlap on the Venn diagram in terms of the products we sell to both channels. And if I take an example of a fruit and vegetable extract, for example, we could sell that direct to the beverage brand owners themselves, and also to the flavour houses who may incorporate it into a further solution. But many beverage companies, as the market trends towards premium, natural, and getting clean label, they can use our products as a drop-in solution in its own right, as a flavour solution in its own right. And I think so. We've got examples there. I mean, if we go back to alternative proteins and some of the chemicals we're supplying into that industry, for example, they exclusively go to the flavour houses, and we're totally comfortable with that. We're not looking to sell those directly to the to the brand owners. There's work the flavour houses need to do there, but there's overlap on the Venn diagram, but there's quite a lot of overlap, but some things are exclusive to both channels.
That's great, thank you. And just one final one as well on ESG. I mean, clearly everyone's now looking beyond scope 1 and 2 and looking at scope 3. Do you feel that you need to do any changes within the wider supply chain in terms of your going back to, you know, a lot of your products you say are grown, they're fruit and vegetables and natural products. Do you feel that your customer, your supply base, are they as on the ball on the ESG front, or do you think you'll require to sort of do a bit of swapping around and finding people who are, you know, perhaps greener or more friendly in that regard? Thank you.
I think there might be a migratory shift, but we're going at this with a very positive lens around education on our supply chain. We think we can bring that experience to bear. And we think we've got that responsibility to try and work with some of our supply chain partners, and we've seen a brilliant response. Certainly, our supply chain team has done a great job in enthusiastically engaging with our suppliers in terms of, you know, helping them understand, in some cases, the importance and the urgency of making positive ESG progress. But I think that we will see some changes, but I think there'll be migratory. But I think the vast majority will be existing suppliers improving their ESG credentials by working with us as partners.
That's great. Thank you very much.
Thank you. There's no other audio questions. I shall just hand back to the team for closing remarks.
Great. Well, thank you again for attending today and your interest in Treatt. We very much appreciate it. And as I mentioned earlier, we'd like to see as many of you as possible at the Capital Markets Day. Look out for the invitations soon. Thanks very much.
Thank you.